Welcome to Echo Trade. I'm your host, Jeff Roth, and today we're here with Eben Burr from Toews Asset Management, and we're getting a portfolio update on their tactical high-income bond model portfolio that's available on Echo Trade. So let's jump in with Eben. Hey, Eben, how's it going? Appreciate you being here.
Glad to be here. Nice to see you, Jeff, and thank you for having me.
Yeah. So we're doing a portfolio update on the tactical high income bond model. Obviously, it's a core fixed income model investing in high yield bonds. And so wanted to kind of take your take on what's been happening this year and kind of what your guys' outlook is moving forward. I mean, obviously, the 10-year Treasury yield continues to rise. So tell us what you guys are seeing in the market and any updates in the portfolio that investors should be aware of.
Sure. So this strategy is designed to be mostly in high yield bonds, but also some in aggregate bonds for distribution of different kinds of bonds, as well as inflation protected bonds. And each of those pieces can move in and out of that into cash instruments, if you will. So it's totally dynamic. And there are times where that's going to serve one really well, like last year when the market was getting crushed, 2020. And then there are times where the market may fluctuate up and down a little bit, where it may not really go much of anywhere.
Yeah.
But then, so for instance, if markets drop again next year, this kind of model could take off and have significant returns, in some cases better than equities.
Got it.
What we have seen this year so far is a sort of floppy, choppy market in fixed income based on the moment of whatever Fed Chairman Powell says the market reacts to, and fixed income has gone up and gone down and gone nowhere mostly this year. So as with us, it hasn't really gone anywhere this year, but what the market is pricing in right now is for the Fed to start dropping rates next May.
Yeah.
Now, if that's going to happen, if that does happen, we're expecting to see high yield bonds take off as they have in the past.
Mm-hmm.
Now, sometimes there's a lag there, like there's been a lag with the Fed raising rates to cool the economy. There can be a lag with dropping rates to boost the economy. I think that historically that's been the case, but that may not be as much the case this time because everybody's so antsy for rates to drop and money to get cheaper again to borrow.
Yeah, exactly. I mean, so that's interesting. I mean, you talk about pricing in around March of next year for rate drops.
Right.
I mean, how much are you guys looking at what the Fed is doing on a meeting by meeting basis, and how much does that affect your decision making, especially with a fixed income model?
Our strategies run on an algorithm, so we have a price reactive model. So we're making changes based on a very quick signal related to how prices change. We're not making predictions about, if Powell says this, we're going to do that.
Yeah.
Because as we've seen many times in the past, the market reacts in weird ways that are unpredictable until after they happen and you dissect them and you're like, oh, I get that.
Yeah.
But, there are many instances where everybody thinks one thing is going to happen and then the opposite happens. So what we do is we try and react quickly to what is happening rather than predicting what will happen.
Yeah, exactly. Talk a little bit about, kind of the relationship between, fixed income bonds and falling or rising interest rate environment. Obviously, we've been in a, historically fast, rate hikes in the last, year and a half. But like you said, there's anticipation that you're looking pricing in March or sometime next year of rates going the other direction. So talk about the kind of the relationship between, kind of the fixed income market and interest rates. And again, like you said, kind of your anticipation for what you guys can see potentially with a falling interest rate environment.
Yeah, I may have misspoken. The market's pricing it for May of next year.
Or for May, yeah, gotcha.
So historically, when rates go from a declining to a rising or rising to declining, when they've changed direction in that way, and this moves very slowly, decades, equities and fixed income tank together.
Mm-hmm.
So we saw that in the teens, we saw that in the 40s, we saw it in around 1980, and now, we've seen it last year.
Yeah.
And now, historically speaking, there's usually some chop after that before direction is established. Fixed income bear and bull markets last a long time. So for instance, the last bear market in fixed income was 36 years.
Yep.
And the bull market that we've had going pretty much since the 80s until a couple of years ago, also
Yeah.
a very long time. Most of us have only experienced a bull market in fixed income. So we're
Mhm.
very set that the fixed income is the safe part of our portfolio and that's it. But historically, that's not the case. So having a dynamic fixed income strategy that can adjust to what's happening in the markets and these uncertain times after a rate changes direction, and this bet that we're all sort of making in our minds that the Fed is going to drop rates is significant and unpredictable.
Yeah.
So we're living in a complex. The market is always complex, right? But at this moment, when we have an expectation that the Fed will change its stance and say, okay, inflation has been tamed enough that we're comfortable with that, we're going to start to drop rates. Now, in my mind, why would they start to drop rates? The economy is strong. There's nothing wrong, right? If the only reason in my mind to drop rates to stimulate the economy and to make it cheaper to borrow money, which means that consumers will take out more mortgages, small businesses will take out more loans, right? That's a stimulative prospect.
Yeah.
That if the market's going just fine, they don't need to do.
Exactly.
So we'll see what happens there.
Yeah, I mean, so with that, I mean, either way though, I mean, you mentioned, with pricing in of May interest rate drops, that could be a significant driver for you guys for this model to drastically outperform even equities potentially.
Yes.
Now, so with that, I mean, but I hear everybody again. You're talking about May, but again, earlier this year they were pricing in that rates were going to start dropping by the end of this year. So who knows if it may or not. But I think everybody, the consensus definitely is that whether it's May or sometime next year, or even in early 2025, if they really get the timing wrong, at some point in the near future they're going to start dropping rates, and that's going to have a positive effect on this portfolio, is what I'm hearing.
That's the expectation of the dropping rates. That's one that you could just keep pushing for years and years and years. And when you look at the market pricing in, as we've been talking about, first it was November, then it was January, then it was March, now it's May.
Yeah.
No one's held accountable. Like no one's like, oh well, you said it was going to be May. I mean, this doesn't.
Yeah.
Change, new data, new information, new.
Exactly. Mm-hmm.
But yes, that is what we believe, that a drop in rates would be significantly beneficial for this portfolio.
That's great. That's great. I mean, so looks like there's a positive outlook no matter what, just the timing on that, whenever it might be, whether it's May or November or early of 2025, it's either way. And this is a long-term portfolio that there's a positive outlook. Is there anything else that you guys are optimistic about right now within the portfolio?
Yeah, I mean, right now, even if nothing really happens in the market, we're getting a coupon of about between 5 and 8%. So even if nothing happens, even if they don't drop rates, the coupon there is significant, meaning the dividend paid. So which is just reinvested or not. But either way, we're kind of fine with what happens. It's designed to be nimble based on market conditions.
Nice. Well, perfect. Appreciate you being here. Sounds like the portfolio has an optimistic future. And investors, you can take a look at the tactical high income bond model on Echo Trade and basically copy the portfolio from Eben and the team at Toews. Eben, again, appreciate you being here. Thanks for the time.
Thanks for having me.